at the 22nd CLSA India Forum, and joining me right now is Adrian Mowat, Chief Strategist at CLSA. Adrian, thanks very much for taking out the time and speaking with us. And it's been a long time since we've spoken to you. Let's talk about what's been happening first on the global front, and then we come down to India-specific conversations. A decade-long bull run for the U.S. equity markets. It doesn't look like investors believe that there is a setback in this extremely liquid environment that we are in, even though there are fears of a recession. How do you, what's your take on the sentiment there, and why do you think that this equity market rally has sustained so long?
So I actually think investors are quite pessimistic about the outlook, but they feel trapped in that they can't really own bonds because bond yields are so low, particularly in Europe where they're negative. And so they have a need to make a return for their savers, whether they be pensioners or owners of insurance products, etc. So they end up owning equities because the earnings yield looks attractive relative to bond yields. So think of them as sort of hostages as opposed to someone who's making an aggressive, positive view on capital markets.
So handcuffed to invest in a way.
Yeah, they're really trapped in this as an asset class. So the S&P has moved up to a new record high. So it's now about 5 or 6% above its high in January last year. So it's been, quite a slow climb out of the depths of the December 2018 lows. So don't interpret the S&P at an all-time high as investors being optimistic. They are concerned about the macroeconomic data, as they should be. You look at the ISM data for the US, particularly the official manufacturing data, still below 50. Yes, we had a little bit of a bounce in the non-manufacturing numbers. US consumption data is quite weak. The PCE number was something like plus 0.2%, so very weak versus what you would expect with a strong labor market. Then if we look at indices outside the United States, so the developed world ex-US is still about 10% below its January 2018 highs, and emerging markets are some 18% below their January 2018 highs. So yes, there's a bull market in the US, but I think it's a bull market generated by QE and central bank activity, forcing investors into equities as the only
lack of other asset classes.
Totally, yeah.
All right.
I mean, the acronym is TINA, there is no alternative.
So most asset classes trading above their intrinsic value. Would you say that markets somewhat are at the brink of, being in this sort of a bubble, or is just a very advanced stage of a bull run that we are, and that still probably has a little bit of more headroom to go?
Well, I'm not sure if I would concur with the view that we're above intrinsic value. One can look at value in different ways. You can look at value versus history. The problem with that is you don't have a time machine. You can't go back and buy an equity 4 or 5 years ago. Wish you could, it'd be very profitable. What you can do is you can say, how does this asset class compare with my other opportunities? And you keep on coming back to the conclusion that equities are quite good value, in some cases very good value versus bonds. If you look at it in the Indian context, we're about average when we look at earnings yield versus bond yields. So I certainly wouldn't conclude that any market is overvalued relative to other assets that I can buy today. Certainly it might be a PE that's higher than we've had in history. All
right. So in light of that, how do we talk about the overall environment when you have the possibility of a recession, you have negative interest yields? How does one put all of these things into perspective and take an investment call?
Yeah, so we're using the R word, recession. And then if we reflect back, what were recessions? In the 70s and 80s, it would be a central bank deciding that inflation was too high, the output gap was too narrow, and they would reduce demand by pushing up interest rates. We certainly aren't in that type of environment. And typically when the central bank did that, they would force demand to go down just as companies were about to open their new factories that they optimistically invested in at the top of the cycle. So I don't have inflation. I don't have the corporate sector over-investing. If anything, we're frustrated that they're not investing more. So is it a recession similar to what we saw in 2000
Maybe not.
and then in 2008 when an asset bubble burst? No, it's not. What it looks like to me is if the US does slip into recession, which is Eric Fishwick's our base case, he's our chief economist, it's going to be very much like what we saw with Germany this year, where you slip into a technical recession and then you slip out again. And it's this very, very low growth environment. When we start to look at the details in terms of earnings, there are quite a number of sectors in the United States where earnings have contracted in 2019. So we're already reflecting that in the valuations, in the PEs. And so as I look at next year, I'm not particularly anxious as an equity investor about this recession because I don't think it's going to be that damaging to the earnings yield. Earnings growth in the United States this year basically flat.
Yeah.
Next year the consensus forecasts about 9%. I think that's a bit high, but I bet that you do get earnings growth next year.
All right. Let's bring it down to in the emerging markets in India then. Mm-hmm. And, we just had a word with Mahesh earlier, and he spoke about how the optimism is around the fact that the government is listening. They're taking proactive measures. They reduced corporate tax, which reflected in Q2 results for most of the companies, so the bottom lines shot up. But that doesn't inherently address the question of the weak demand scenario, the weak top line growth that we're seeing. So how can one, probably take a call and say, I'm going to put my money in India at 17 or 18 times, even though I'm not seeing much growth?
So I think it's back to what are the opportunities for the domestic investor. So the domestic investor has generally been rewarded by buying the equity markets. And they do it in a very consistent way, and you can see it through the inflows into SIPs. Our forecast is that interest rates will be falling globally, including in India. You typically get a pickup in demand for mutual funds as fixed deposit rates fall. So I think the cash flow dynamics for the equity market, will you get net demand, look quite good just based upon the domestic investor. Mm-hmm. When I step back and look at the Indian situation versus some opportunities I've got elsewhere, what we're seeing in North Asia is some very high growth stories, some positive earnings revisions. So they're coming through in the semiconductor space, which is a very large part of the benchmark in Korea and Taiwan. In Taiwan,
you're overweight in Korea and Taiwan.
We are overweight Korea, Taiwan, and that's really driven by the tech story. So we've got a big pickup in earnings growth in tech as the semi-cycle turns. Earnings revisions are positive. I think valuations are attractive. So that's where I think you're going to see the leading performance in emerging markets. Then if we look at China, there's some very high growth sectors in China like e-commerce. So e-commerce and the consumer discretionary sector of China is 7.9% of the total emerging market benchmark. That's almost the same weighting as India as a whole country. Yeah. And so these are the opportunities, and so this is where we're advising clients to be overweight if they want to outperform the emerging market indices. And then we're funding that with an underweight in India and in the ASEAN region. I think you will be making money in India and the ASEAN region, but in the first half of 2020, I think you'll make more money in North Asia.
So let's talk about that underweight on India.
Yeah.
I mean, we've seen Moody's change their outlook as well. They've probably, brought it at par with what the other rating agencies have done. But your reasoning for the underweight on India, and how long can this continue?
So my reasoning is I can make more money elsewhere.
Okay.
Right. And people often misunderstand an overweight and an underweight as a proxy for buy or sell, or a statement that if you're underweight, the market's going down. I'm advising investors in emerging markets or Asia Pacific ex-Japan benchmark on how to outperform their benchmark. So where do I get the higher return? And as I look at it, we're going to get the higher return in North Asia. Now, it's quite possible that often happens in stock markets is the discounting is very rapid.
Yeah.
And so, if Korea and Taiwan outperform considerably over the next quarter, then we may be reviewing the situation and thinking about relative returns for the balance of the year. And so that could result in money flowing back into India without any changes in the underlying fundamental dynamics of India. Now, what would encourage investors to come back here would be positive economic surprises. So evidence that the corporate tax cuts led to a pickup in business investment. I think that would be a very positive sign. If the government can do a little bit more to boost household real income, particularly in the rural sector. So we've had very low increases in the minimum support price. So yes, the agricultural sector has become more efficient. Output in terms of volume of agricultural products have gone up, but the pricing effect that they used to enjoy is much more modest. And we can see in the anecdotal data that rural demand is quite weak. The other area we need to think about is urban job creation. India doesn't have particularly robust statistics around employment and consumption. And so we're reliant on anecdotes. And unfortunately, a big employer, which is the auto industry and auto ancillaries, according to the Automobile Association of India, 5 million contract workers, about 10% of them have lost their jobs this year.
Yeah.
And so we'd like to see a turnaround in manufacturing employment. See an increase in service sector employment so that you can see a boost in real urban household income. Because remember, India is a consumption economy.
Yes.
It's not an export economy. It hasn't been a manufacturing economy. And so you always need to go back to what's happening at the household level, because that'll determine your growth rate through consumption.
Yeah. Let's go back to that manufacturing point. I mean, the government has given a boost to set up manufacturing units in India, tax rate of 17%. That's not a bad deal. Do you see India making the most of it, making its place in the global manufacturing supply chain?
Yes, so the overall corporate tax rate sort of brings India in line with other countries, which is great. There's no point in being competitively disadvantaged. Yeah. India has the benefit of a huge domestic economy. And quite often the most competitive exporters are those that, say, export 10 or 20% of their production, and the balance is for the domestic market. They have this big economies of scale. So India continues to offer that attraction for global investors. And I think bringing down the tax rate, moving India up the league table in terms of ease of doing business, these are all reforms that will have a good long-term beneficial effect. Short-term, the issue for business investment comes back to your question earlier about the weak demand environment. So why would I build a bigger factory? First thing is there has to be demand for that product.
True.
If there is demand for that product and the tax rate has come down, then my threshold financial threshold will be lower, right? But ultimately, I must have the end demand. And at the moment, I'm struggling to think of the industries in which there is a lack of capacity where business investment, manufacturing investment makes sense at this point.
I mean, current capacities are not being utilized to the fullest.
Quite. The other issue we need to think about here is the trade tensions.
Yes.
So now clearly there are incentives for companies to move manufacturing capacity from China to get around the issues with the trade dispute between China and the US. However, moving to India is not an obvious destination because, unfortunately, trade tensions between India and the US also exist. And so I think it's not a sort of clear decision point. And if anything, we're seeing probably a preference for places like Vietnam.
Yeah, so it's not like, the earlier conversation at the beginning of the trade tension was that there's this big gap that India is ready to fill.
Yeah.
But that doesn't seem to be the case. At least in a few of these segments. Let's talk about earnings then. And the earnings growth has been slow. We've been seeing, earnings estimates coming down from 25% to low teens, and now just about settling somewhere post the corporate tax cuts to about 17 or 18%. What's your sense with regards to the earnings for India in particular, and do they justify the valuations?
So I definitely think there are risks to these earnings numbers coming down. But it's important when we now talk about the stock market to understand that the composition of the stock market has a big bias towards the financials, particularly the private sector financials. And to some extent, the well-run private sector financials effectively benefit from the problems in the financial system. They can grow their share of the pie because the PSU banks don't have sufficient
Yes.
capital, maybe don't have the risk-taking appetite that you really need to run a financial business. The issues with the NBFCs also play in favor of the better run NBFCs, whether they're in housing finance or just broad NBFCs. So I think you can have quite good earnings growth, but it's really a stock
Limited
story
to,
rather than a broad story. The question is, are we going to see good earnings growth in cyclical sectors? After such an awful year for autos globally, maybe you get a little bit of a recovery. And we have been seeing some of the auto stocks recovering from very low price levels. There is a chance of positive revisions coming out of the cement sector. As interest rates have moved lower, we should see a pickup in demand for housing. Hopefully that helps clear some of the housing inventory and then leads through to new construction activity. The government here has been very effective at building infrastructure, and that will continue. So I think there are some cyclical opportunities, but they're very selective.
So, we've been talking about how at the start, during the budget announcement, there was a whole talk of a push for infrastructure and capex from the government. But now that comes into question with the dole out of the corporate tax concessions that they've given and fiscal strain that it's going to put on them. So they don't have that much headroom to go ahead with big ticket capital expenditure. Is that going to be a little bit of a setback?
So I think they'll still go ahead, right? And that they'll take a view that they'll be willing to run a bigger fiscal deficit. The thesis behind a corporate tax cut is that, yes, initially you've got a loss of revenue, but that reform ultimately gives you a higher potential GDP growth. And at that higher potential GDP growth then replenishes the coffers at the Ministry of Finance.
Yeah. There was this excitement at the time of the election verdict. And the anticipation was that there's a stronger, the same government has come back with a stronger mandate. They've won with a better margin than last time. But it didn't result in a lot of money coming our way. And that was the initial feel that we got, but it didn't really translate in much. If anything, post the surcharge being announced, a lot of money went out. It started to come back in slowly. Do you see foreigners really being interested in India?
So we need to first of all look at this from the perspective of global mutual fund flows. So we've seen outflows from actively managed developed funds as well as emerging market funds. And a lot of mutual funds are run passively versus benchmarks. So India is seeing outflows, as is the rest of emerging markets. So let's have that as a context. And I think that's probably been a more important driver than necessarily the local conditions in India. I've been looking at India for many decades and have spent an inordinate amount of time and usually wasted money around getting tax advice in India. India is the only emerging market that charges capital gains tax on wholesale investors. So wholesale investors are, the mutual funds, the insurance companies. Their end investors pay tax. So India, for some reason, wants to give itself a big competitive disadvantage. And the shock around that budget announcement on the capital gains tax does have an impact in people's medium-term confidence on making a capital decision in India. And so my advice on this is that we just need a clear statement that wholesale investors will not pay capital gains tax. You can charge them, as many countries do, withholding tax on dividends. But India does need to wake up to it being at the exception with this. And I think clearing that would be a very, very useful thing to do. Remember, at some point, the Indian savings pool will like to buy, will have some international diversification. They don't want to be at a tax disadvantage when that's happening.
True. So let's talk about, you said, and we were talking to Mahesh as well, last year's theme was real estate, and he said that it's going to continue to do well. What else do you feel one can look at from an overweight standpoint within India? Any sectors?
Yeah, so I think, I showed a slide in my presentation which was just looking at how consistent stocks appear in the top 10 in the Nifty over the last 11 years. And it's to some extent, India remains a run your winners story. So you remain in your key private sector banks, private sector NBFCs that are doing well. You know, that is the story. It's a portfolio that doesn't change
Pay a
very
little
much.
more, but will keep you safe.
Yeah. Well, they have compounded at a pretty decent growth rate. And yes, they look expensive, but you know, in a world where growth is in chronic short supply, a consistent growth company, you know, deserves a premium.
All right, got that. Adrian, thank you so much for joining
Pleasure.
us.
Thank you.
It was great chatting with you. Thank you.
Thank you.